Well, welcome everybody to the Ultimate Advisors Resource Podcast. Today I've got a very special guest, Susan Bryant from Unboxed Advisors. She's a CPA, a certified tax consultant.
Yep, strategist.
Strategist, sorry. And I would say one of the most proactive CPAs I've met in a long time. Well, in my career at least, which is not a ton of time, but
Well, the bar is pretty low.
the bar is pretty low. But before we begin, my name's Jordan Pence. Our company is Advisors Resource Company. We help advisors grow their insurance business. And we have an interesting topic. I called it the art of tax planning. And Susan, I think you really like that title. What do you always say something funny about the typical advisor. They're male, pale, and
male, pale, and stale. That's pretty typical too. So, yeah. So
I didn't mean to put you on the spot with that one.
Well, I mean, generationally, that's just sort of the environment I grew up in public accounting.
Yes.
And the career itself is so demanding that really it has been difficult historically for women to break into that career field and stay there just because of how demanding the hours are. So fortunately,
Definitely.
yeah, things have changed a lot. I think, public accounting was notorious for that type of work environment and sort of the tax season, and things have really started to change.
It sure does seem that way, especially in the maybe, I don't know if you call it like independent practitioner space or whatever you would call it, where, you've got a CPA firm and then, a couple CPAs doing taxes for business owners in the area. That seems like it's somewhat changing over at least the past maybe 10, 15 years.
Yeah, and you know what the biggest thing is that's changing it?
I have no idea.
The switch from tax preparation to tax planning, because it's a lot more advisory. And there's just such a more significant return for those clients when someone takes the time to actually understand who they are, what's going on with them, what their plans are, their entire financial picture, to help them figure out what decisions they should be making today that are going to benefit them in many years to come.
And I think that's a space that especially the business owner really appreciates, because they do. We had a study, or I looked up some stats, and I think it was like 65% of business owners look at their accountant as their most trusted advisor. And that was like second to, I think, financial advisor at like 15%.
Yeah.
So.
Right. It's a really important position, which is why there are, so many, like every 2 years, I have to take a ethics class. I mean, there's a lot of trust put into accountants. So we do have a special responsibility and duty to our clients to make sure we're helping them think about and make good decisions, especially when it comes to taxes.
Exactly. So when most people think about tax work, CPAs, tax planning, they think about April 15th and when they've had to pay the taxes. So what is the difference between, like filling out the boxes, right? Tax filing, doing the compliance work versus like real tax planning? And I think especially for business owners, but maybe high income earners that are making a W-2, what does it matter, or why does that make such a big difference for them?
Yeah, well, thank you for clarifying that. Tax preparation really is just taking the numbers after the fact of what
Keeping
actually
score.
occurred. Yeah, we put it in the return, and that's preparation. Tax planning is something altogether different, because it is taking information based upon what happened last year, what's happened the current year, and what we want to happen in future years. What kind of decisions do we want, how we want to grow our investments, what particular diversification are we looking for, what type of opportunities might we be interested in taking advantage of under the tax code, and what decisions are we going to be making today, tomorrow, and all the many tomorrows to come that would influence what that tax position looks like. So tax planning is much, much, much different. This is strategic. I mean, there is definitely a level of execution that's necessary. So there is some tactical work that needs to get done.
So like the implementation.
The implementation, yes. And that's, I would say, probably where most people fall short. Everyone loves to hear ideas, but actually getting the stuff done is another challenge. I mean, it's 90% paperwork. Okay, so all of these ideas is just fill out the paperwork, get it done, follow up, make it happen, and then keep it going.
Well, I guess that's a really good point, because think about even implementing like a qualified plan or something.
Right,
Like,
401k, defined benefit plan. I mean, it's work.
we could talk about it all day long, and then it's like, okay, let's do a DB plan or defined benefit plan or a cash balance or whatever it is, or even a 401k, and it's like, all right, now we got to go through the plan documents and then get everybody's information.
And it does, but it doesn't stop there, because then you've
you have
got
the
this
ongoing
annual census, and you have to make sure you're doing the payroll correctly, and then you have to remit the deferrals timely. It is work. So I would say that most of the time, when I think the thing that stops most people from actually going from the idea of I want to do tax planning to actually doing rate tax planning is that they don't have the right partner to help them continue the execution in a seamless manner.
And you're talking about from the accountant side.
Yeah, I'm talking from the
Or the client side, maybe both.
I mean, it's the client side. It also does become with the financial advisor. A lot of times, there kind of really needs to be a chief person, like somebody who's really kind of the leader. I'm going to make this happen, but it takes other people working together to make sure everything gets done.
Yes. No, I totally agree, and that I think is like your practice and is modeled somewhat more like the quarterback position almost, which I think is very unique in the CPA tax advisory, tax planning, tax preparation area as opposed to most CPAs and other advisors out there. But that's a really good point. The implementation, I think, is arguably one of the more important aspects of it, and people generally fall short on that.
They do. And I would say second to that is truly understanding who the business owner is, how the business operates, what the business is engaged in, what are their biggest challenges, the biggest risks, the biggest opportunities, and then sort of going to the personal level, asking the same thing: where have they invested their money? What opportunities do they have? What are they interested in growing? So it really is a broader picture. It's not just this: how can I save income taxes in the current year? I've done
That's
that.
a really good point.
It is a much bigger question. Here's an example. So when I first started really getting into tax planning, shortly after the TCJA was passed back in 2018, which everyone all of a sudden was interested in tax planning because now we had the QBI deduction and you actually needed to do some planning.
Yeah, the QBI thing was big.
It was big, yeah.
It was huge, and we should really still be talking about that, actually.
We should, because people still miss it.
Exactly.
It's incredible, because people still miss it. So, okay, let's get back to that.
Yeah,
Okay. But when we first started doing tax planning, one of the things that we did a lot of was like defined benefit plans, because it was huge. We could save a lot of taxes, a big chunk of money, and fantastic. But the more and more that I've done this, I really had to ask a bigger question, which is like, is having any more money in a pre-tax bucket good for you in the future? Because if that's all you have, that might actually be a huge detriment in retirement. So
that's a really good point, and I don't mean to interrupt you, but to further that conversation, also the restrictive nature of those types of plans.
Yeah, right. So there are other things to think about other than just taxes. So not too long ago, maybe a year and a half ago, I had a couple approach me, and they had saved a significant amount of money in 401ks. They were W-2 employees, but now, they're in retirement, and they're approaching the required minimum distribution age, time to pay the piper. And they're like, but we don't want to. Well, you've kicked the can down the road.
You have no other choice.
And you have no other choice. Yeah. So
I mean, you could convert it to a Roth.
You could, and you could.
But you're going to pay the piper anyways, right?
And I mean, there's some strategies, but they're not without risk.
Sure.
So now you're picking your poison.
Yeah.
Pay the taxes or take risk of losing principal. Which do you want to do?
That's a really good point.
Yeah, so I don't know. I think that the conversation needs to start with, like, maybe at the business level, what opportunities, but then it needs to be kind of broader at the individual level, and then maybe even broader to like the time horizon beyond that.
That is a really good point. And you get a lot of business owners. Well, you probably have better experience in this than I do, but people will say, it's the end of the year. What should I buy? Or what should I do? And it's like, well, if you just want a deduction, you could do the qualified plan, or you could buy a truck or whatever. But do you actually need it?
Well, that's going to get real tempting now that the OB3 has brought back 100% bonus depreciation. Everybody's going to be like, well, I'll just buy a bunch of stuff. And, you know, $1, I mean, cash is still better than a deduction of 35 cents on the dollar.
Yeah, you had to spend $1 to save 37 cents. 37 cents.
It's a top marginal rate. So I think I'd rather still have $1. You know?
I think I would, even if it's going to cost me 37 cents.
Yeah. Still you end up with more. So, you know, I think one of my pieces of advice there is always, we're spending money. If we get a tax deduction, that's awesome. But there is a secondary ROI piece to it, which is it's useful to our business somehow. How else? It's generating revenue. It's saving time. It's making something easier. It replaces a piece of old property. So if something else we're benefiting in some other way. So it's got to kind of be a twofer. It has to be.
It has to be, and it's like the same question. A lot of W-2 people ask this, and you've probably had them ask it. Should I buy a rental house to save in taxes?
Right. I've actually seen people do that, and it is a long-term residential rental, and they make too much money, and they cannot benefit from the deduction. And they're like, "Why didn't somebody tell me?" And
now you're replacing the toilet at 10 p.m. or whatever.
That's true too.
Sure.
Okay, so the comment we just got says, have you ever considered the Medicare cost penalty for making too much during the year due to R&D? No one wants to pay more.
Have I ever? That's a better question for you.
I mean, I think that we have to always consider what I refer to as layers of tax.
Yes.
Okay, so it's always thinking about, okay, federal income tax, then it's state income taxes, then it's, of course, Social Security and Medicare taxes, and then we're even getting into like property taxes and then sales taxes. I mean, we need to be mindful of all the different layers of taxes that we're paying. I think we become a little bit complacent.
Yeah.
And like, oh yeah, there's tax on that. Oh, there's tax on that. We can make different choices.
Yes.
Like if you go to the grocery store and buy a bag of chips at Kroger, you're not going to pay sales tax on those chips. But if you go into a convenience store, you're going to pay sales tax on those chips.
Really?
So you could, I mean, you think about that. I mean, like, you want to get down the nitty gritty.
I didn't even know that.
Because it's food, right? So, but convenience stores are taxed differently. So, I mean, there's just stuff like that. So I applaud that type of thinking. Like, we have to be thinking of the different layers of tax for us that we're paying.
Well, and to further that exact question, like, okay, you have IRMA, where if you make too much, you're going to pay more for whatever it's the health insurance thing, right?
Yeah, yeah.
So, exactly to your point, it should layer on layer on layer.
Mm-hmm.
I like what you're saying about the qualified plan thing, and you've got to think longer term and not just in this, well, what can I buy? What can I do to save a little bit of tax? And sort of like the accelerated depreciation on rental properties or things like that. Like, okay, well, that might be a good strategy, but if you get your income down to zero, is that smart?
Oh, well, yeah, of course. So, this is going to be interesting because the OB3 expands the 10% and the 12% brackets.
Right.
Okay, so
right
now we're talking about, I have more room. I mean, paying tax at 18, 22%, almost not too bad. Okay,
no,
so,
if you're making, if you're in the top brackets, paying 20%.
That's not terrible. So
I'll take that all day long.
Why would you want to deplete your income down to where you're only paying 10 or 12, 15% by using up these very valuable deductions? So yes, you do need to be mindful about and thoughtful, and this is where you got to put that planning hat on, is like, if I chose this deduction this year versus next year versus the following year, how does that influence what my effective tax rate is? So you have to be sort of approaching it that way.
No,
if
I
not,
agree.
you're really just you're wasting your own money.
You're wasting a deduction. Like if you get it down to zero, let's say, you're wasting part of your deduction to save 10%.
Yeah, where it could be the next year on 35 cents or 37 cents.
Yeah, exactly.
Like, who knows?
Exactly.
So yeah, the effective tax, managing your effective tax rate, and it's okay to pay some tax, and pay it at the lowest possible brackets
Yes.
you can. So manage the bracket management.
That there's been all types of different strategies and concepts about that over the years, and it kind of almost circles all the way back to your beginning thought about stop doing defined benefit or maybe don't do as much into the qualified plan, because then how are you going to manage that on the back end?
Sure. Yeah. Well, I know that you are aware, and these are things that I talk about with my clients too, is you got to have more than one bucket.
Yes.
So, which is, I think, where you and I end up spending a lot of time together,
Yes.
sort of helping clients to strategize about, okay, great that you've built up this qualified pre-tax bucket, but what happens in the future when perhaps you don't want to use that money? If there is a change in tax legislation, if the market is down, where do you go to? And that's usually where I'm telling people, oh, you need to call Jordan, because we need to talk about adding another tool in the tool belt, which is looking at how the life insurance and the cash value that accumulates in the life insurance can be so valuable in those particular situations.
Well, and to further that discussion, you're exactly right, because it does come out not taxable as opposed to a qualified plan being 100% taxable. But it also brings up even a greater discussion about entity planning and how you decide what entity is right based on maybe what they need to consume, right?
Sure, 100%. So many times people don't even really understand the differences between all the different types of entities, and not just the tax benefits, but even just what it means from how that entity operates.
Yes.
And so this is maybe where we've got to have a solid legal counsel, general counsel, someone who is working alongside the team to make sure that the client really understands, like, what this particular entity is going to lend in the mix, right?
Oh, no, that's totally right. And I can't tell you how many times I've asked either an advisor or a business owner or whatever, and you probably experienced this. But so what type of entity? Like, how is that taxed? Oh, it's an LLC.
Oh, yeah, 100%. Yeah. Well, that can be taxed 4 ways. Okay, so yeah, this is the chameleon entity there. Yes, it is. Every time I have given a presentation to kind of new business owners, like in a startup class or something like that, I always I want to make sure everyone leaves this class and can answer the question, what type of entity are you and how are you taxed? Everyone, let's make sure, we'll go around the room, it's almost like roll call, because it's...
My name's Jordan, I'm an LLC, taxed as an S corp.
That's right, exactly. You'd be surprised the number of people. I think you get instant credibility when you start talking to other financial people and you actually have that information and you know it. And even better if you know what that means in terms of how your business is supposed to operate.
I 100% agree. And when I talk to other advisors or even clients and I ask them that question, and that's the thing that drives me crazy the most, is like, well, he's a LLC, and it's like, okay, no, how is he taxed? Well, he's taxed as an LLC. I'm like, no, that's the wrong answer.
Yeah, exactly. You wish you had the Jeopardy. Price is Right or something.
Oh, man. So what do you think is the biggest missed opportunity with tax planning?
Oh, such a hard question.
The lowest of low-hanging fruit. And don't say qualified plan. I don't know. It could be anything.
Well, there's just so many things that get missed by most business owners. I think the first thing is just, the biggest thing is just terrible accounting. They have bad accounting records. So they are missing the opportunity.
Bad books.
Yeah, they have bad books. So that just needs to be you got to have good accounting. Okay, then you start getting into more like, okay,
So-
more things to think about beyond that. Are they really doing their home office right? Are they taking advantage of the Augusta rule? If they are in real estate, are they doing all the things that they could and should be doing when it comes to how their improvements are getting capitalized, or can they make an argument to expense those?
Right.
Are they doing cost segregation studies? I mean, if their business has research and development, I mean, that's kind of what's on pause for a while, but now with OB3, it's back. So, I mean, it's just leaving no stone unturned. That's usually the biggest mistake. And that's 100% working with the wrong people.
Well, it's not communicating.
Yeah. Well, sometimes business owners are kind of closed off.
Yeah.
Maybe that's one of the biggest mistakes is like, no, I got this. Like, you don't got this. Like, let someone help you. Be
That's a
open to
good
that.
point.
And I get it. Business owners are very entrepreneurial. They are innovative. They have got a lot of great ideas. But when they actually give control and sit there and say, yes, I'm going to help you think and brainstorm, like, well, what about this? What about that? And they take the time to sit alongside someone who really wants to help them find those opportunities is a lot more productive. But being closed off in too much of a hurry and don't have time for that and just prepare my return, that's where you miss stuff.
You're probably right. And I mean, I think the books thing is actually a really good point, because I imagine most businesses, especially in Texas, are probably construction based, and they just have money coming in and money going out. And as long as the bank account's growing, they feel like they're doing all right.
Oh, well, everyone just looks at the bank account. Sigh. Accountants, we're all just, spending can be such a major issue in business. But a lot of times, business owners are coming looking for not only ways to save taxes, but how to build a more valuable business. And the first place you have to look is as the accounting records. Cost cutting is only going to get you so far, just like saving taxes is only going to get you so far. Really, it's how do you build the top line the most strategically.
That's a really good point.
It becomes sort of that's where the conversation eventually evolves. So once you get spending under control, and then you're like, but I want to make more money. Well, then you got to look to the top line. So
yeah, that's a really good point. And if you don't have good books, how can you make a good analysis of?
You can't.
Product A is working better than product B. Why are we doing product A?
Yeah. Yeah. I mean, everything starts with accounting.
Yeah.
I mean, that's why Warren Buffett says accounting is the language of business. It's fundamentally the beginning is like.
Does he really say
Alpha
that?
and Omega. It is the beginning and the end. It all is in the accounting records. Yes, he really said that. So
I guess that's how you're keeping score.
You are, and how you know what moves to make. Do I have cash? Can I mean, we all know that great tax planning takes cash.
Yeah.
If you want to do a defined benefit plan or a 401k plan, or you can purchase something like.
Yeah.
Or if you're interested in, maybe pivoting to, contemplating a strategy that involves maybe a captive insurance, if you've got that type of risk in your business, or life insurance, it's gonna take money.
Yeah,
so,
no doubt.
Yeah, you got to know how much money and how much cash that your business can withstand to take out in order to really start saving on those taxes.
Speaking of captives, I'm glad you brought that up. Those were so popular. It seemed like 7-8 years ago. And then they became not popular.
Yeah, I'm suspecting they are going to continue to grow in popularity.
As long as it's a legit reason like this.
You got to have, it needs to be so there has to be a real business risk.
Right.
And I would say, arguably, most businesses, and when you're working with the right person to help you assess this, really, it requires an expert.
I think that's important.
It is. It's important to work with the right talent and the right experts, especially in these kind of niche areas of the tax law. But if you have legitimate risk in your business, it can be a very effective strategy. And ultimately, you're self-insuring anyway most of the time as a business owner. So why not self-insure in a more structured manner?
Well, especially if you're, like you're a high liability type of company where, you're paying a lot of money for property and casualty. This could be a way to potentially recover some of that cost while
It is, yeah.
saving.
So it doesn't typically replace any commercial insurance, but it can. When you raise your deductible, which then you can offset to a captive, they can reduce that premium. And I don't know a business owner, one, who has not been hammered with insurance premiums, all of them.
It seems like they talk about it all the time.
And there's a lot of things that we know now that are really big risks, especially following COVID,
Sure.
that we maybe otherwise would not have called a risk before in a business. So, that lovely business interruption. I mean, how many people actually had business interruption insurance during COVID? Nobody.
That's a really good point.
So now
Yeah.
you've got, I think there's a lot more risks, whether it's key person. I was working with one of my clients who they resell products, and they're worried about the product liability insurance of the manufacturer being adequate. And so they want to make sure that when they've resold it to their clients, that they have adequate insurance. So they've set up a captive, and there's 10 or 12 policies that are getting purchased every year to make sure that those risks that are not commercially insured are actually
Wow,
insured
that's pretty
properly.
interesting. So they're
Yes.
reserving basically through the captive for the amount that's not covered by the policies.
Yeah, that's right. So, and there used to be, this used to be on sort of the dirty dozen list for the IRS.
That's why I brought it up. 'Cause,
Okay.
Yeah,
But you know
that's-
what
that's
else
why
used to be on the dirty dozen list? 401ks.
Really?
Yes, which is actually crazy to think about. So,
Because that's so vanilla nowadays. I mean,
Yeah,
that's
exactly.
the most vanilla flavor you can buy, I guess.
it's probably going to be on next year, Trump accounts.
Good point. Good point.
But now they are not even reportable transactions. There's just a disclosure
Yeah.
that has to be filed.
Yeah,
So,
yeah.
but
So, how early should somebody think about like tax planning? When you've got like this, like a startup, should they start thinking about it immediately when they're starting up? I mean, they may not even stay in business. And then you've got somebody that's like transferring their business all the way up to that.
So I would say a couple things. One, new business owners might not necessarily need tax planning as much as they need tax education, because if you make mistakes when it comes to entity formation or payroll taxes, or maybe not filing on time when it comes to your federal returns, that can be real pricey. So I would say seek help, get clarification as to what your responsibilities are so you don't find yourself in a big mess later.
Yeah, that makes sense.
Don't screw it up.
Don't screw it up from the beginning.
Right. At the point at which you're starting to turn a profit, then and sort of, if you're doing things right and you're doing projections, right, like you actually know, like, this is how much money I'm planning on making and I've got a plan to get there, that's really the point at which you need to pivot towards, like, hey, I need to move away from just this education and making sure we're compliant to help me to plan a better way to preserve my profit for future investment and to grow my company.
Yeah, that's really interesting, because I don't know that a lot of smaller businesses do the best job of the forecasting aspect of it.
No, they don't. But there's so many tools now. I mean, it's incredible, the models. I mean, they sync with like QuickBooks, and then you can
Really?
put in, and it'll go back and look historically and run some, I'm going to forget the word. It's like a math word.
Oh, Monte Carlo?
It's an algorithm that'll go back and it'll look at the history, and it'll basically project out what it is based upon historical monthly activity. I mean,
Really?
you can put formulas. I mean, gone are the days where you have to have some sort of, giant Excel
like a
spreadsheet
abacus or
and
something.
right, an abacus, yeah.
I don't know.
Or you know how Excel spreadsheets were used for so long for that
Oh,
stuff.
yeah.
And then you had to go and update it when the actual is posted. Now that stuff's just all automated. So there's so many tools out there. I would just encourage business owners, and same on the cash planning side.
Oh, yeah.
Cash forecasting is the same way. It all just syncs with QuickBooks. You have to maintain it and understand how it works. This is probably where you need a little bit of education and help. But once you understand it, boom, now you've got a way to not just manage your business in the current month, but as time passes, and you can start to see further into the future.
That's really interesting. And we internally, I mean, financial professionals like our firm and even the advisors that we work with should probably be doing the same thing. And I'm definitely not doing that. It would be smart to do that though. That makes a lot of sense.
Well, it sort of mirrors what financial advisors are doing on the personal side, which is, like the Monte Carlo, the personal financial plan.
Yeah,
like
we're going to project this amount of growth.
Like this is what kind of income I'm expecting. This is kind of expenses I'm going to have. Like I'm going to have a one-time cost of this. I mean, really, it needs to be happening at both levels.
Oh yeah.
And I will say that's usually a big thing with every client. I can think of no clients I have onboarded in the last couple of years where we've walked in and the business has a forecast and their advisor has done a personal financial plan.
Oh
where
yeah.
both of those things are in place.
Yeah, that
and
never
so
happens.
they're sitting pretty. They're like, oh yeah, I'm going to be retired on X date because I know exactly how much money I'm going to have, and they don't know.
Yeah.
I honestly don't know how most people get to sleep at night not having this information. Maybe that's the accountant in me. I'm like, I must have it nailed down.
They probably drink.
Yeah. He probably has it. We'll just have a cocktail and you forget about it.
Yeah.
Numbs the worry. You're probably right. Probably a little bit of just going on vacation, or better yet, adrenaline. Sell something. Okay, sell something. Oh, you have no cares in the world. Like, I just sold something. I don't care. You know?
I feel great. You know what's funny about that? Me and my wife took a vacation. We were in Colorado, and I'm in the hot tub sitting next to this younger guy. And he's got no care in the world. I'm like, so what do you do? He's like, well, our family just sold a bank somewhere in Texas, and I got a little payout out of that. And I'm like, so what are you gonna do? He's like, oh, I don't know.
I don't know. Well, he's like,
same exact.
Cha-ching! Yeah, but is he thinking about, I wonder how I'm going to minimize that tax liability on the capital gain?
No, it's way too late.
He doesn't even care.
He doesn't care.
He's like, I pay people to worry for me.
Hopefully, maybe. Who knows? I have no idea what he does. That's funny. So, you don't have to, I don't want you to name any names, but what is a really good example of a scenario where some thoughtful tax planning or some like creative tax planning had a massive impact in someone's situation that was maybe not quite obvious, or it was just like not obvious, or because like I could say do a qualified plan, which I think we've agreed that's pretty weak advice.
Yeah, I mean, it's kind of like table stakes right now already. I think the interesting part of this question, Jordan, is I don't know if I'm old enough to answer it.
Oh, that's
okay, because some of the work that we're doing right now is really going to build so much wealth into the future that I'm probably going to be dead before anybody really understands how valuable it is.
That is a good point. Yeah.
So, I mean, I hope that that's the level of contribution that, you and I are doing, like, in the tax planning that we're working on, because we are thinking of all those things, not just today, but tomorrow, and not just federal income taxes, but also thinking about state taxes. And our lives got a little bit simpler to the OB3 since that's now $15 million per person and will be indexed with inflation. So things get a little bit more comfortable.
That is a good point.
We still have to be mindful, but I think I just have to be older. I mean, and then hopefully someone will report back to me and say, you changed my life.
You saved me billions of dollars, Susan.
And then they send me a check. And
yeah, that would be nice. I think that's a really good point, because so much of tax planning gets conflated with deductions and current savings, when really it's more about positioning long term to make sure you're in a good spot.
It's compounding, and it's compounding. I mean, not just over 1, 2 years, 3 years, but decades.
Yes.
25, 50 years. I mean, you kind of think about how some of that stuff could really impact.
Well, yeah, that's
even entity choice, entity election, right? That can matter. I mean, where do they choose to buy a piece of real estate? Was it in a S corporation? Wrong.
Yeah.
A partnership or a single member LLC? Better.
So,
I mean, were they active in a business or were they passive in a business? Have they been mindful about the type of income they're generating? I mean, even my mother-in-law, who is 90 years old, like sadly prepared her return to help out.
no.
But I'm looking at it, I'm like, why is she paying taxes? So it's like, we went back and had a conversation with a financial advisor. This is when interest rates were much higher. Like, we need to be buying municipal bonds here. Why is this woman paying any tax whatsoever? Because as her taxable income is going up, now that's making more of her Social Security taxable. Like, we should be asking these questions and having these conversations. And
She should be doing that, or she could buy annuities too. Tax deferred.
She could. That's right. So, it's
There's
just,
so many things that you can do.
There
There's
are.
no reason.
And
And maybe it's more about the coordination of the advisors.
It is. It's somebody taking the time to be like, could we do better here? Just
Yeah,
could we do better?
Well, that's not my problem.
Right. Or I don't have time to look at that.
Yeah.
And
Yeah.
I mean, I don't blame any particular industry, but there are competing priorities. So one,
Yes.
accountants, there's just more complexity. There's fewer people who are trained to do this work.
Yes.
People are getting older. People have left the industry. Okay, you've got that sort of storm brewing. And then you look over at the financial advisors, and they're compensated based upon the assets under management. Okay?
And they're actually judged on the returns that they provide typically.
Yeah, and so they're incentivized to go get more,
Yep.
because that's the only way they're going to make any money. So you have basically two of the most important people in advisors in a business owner or high net worth individual's life who's basically are just overloaded and overworked. And we all know that
Yeah.
when you are that busy,
That's a good point.
it's hard to think.
Yep.
These complex things take time.
Well, and it's even harder to implement.
Oh, yes. Yeah. And you miss deadlines, you miss this stuff. And
Yeah.
I mean, it's hard to get stuff done.
Yeah.
It is
And
hard.
you could also come back to like the clients as well. They have a bit of a challenge getting things done because they're busy, right?
Oh, they're real busy. Yeah. You have to make it easy to them on possible. It's like, I'm going to explain everything to you and prepare everything, and I'm going to send it to you. Just sign it.
Yeah.
That's all you have to do. Because if it requires, I mean, they get stuck. And I don't blame them. It's like you get a piece of paper and you're like, what's your EIN? And they're like, I found that. What's the SIC code?
No, you got to make it easy.
They're like, I have no idea.
You got to make it as easy as possible.
You have to make it easy, or work with somebody who's got that information handy and there can be that level of collaboration. So,
Yeah, that's kind of the power between the accountant and the financial professional.
yes, and and those niche advisors. If you end up with a captive or R&D or a cost taker, I mean, funneling the information to them to keep them moving the project along so that you can actually get it done, so we can actually implement it and quantify it and plan for it. And
Same
everything.
with the attorneys.
Same with the attorneys. Same with the attorneys. I mean.
No, it is.
There's a lot. There's a lot going on. And you think about banking, and thank God we don't have the Corporate Transparency Act anymore. I mean, there's just so many
that was kind of
things.
crazy,
That
wasn't
was
it?
crazy, yes. So,
All right, so you named an example just now about your mother-in-law not coordinating, right?
Right.
Do you have any other examples of that? I mean, it probably happens so frequently, it's probably hard to think of a specific example.
oh man, just
Similar
look
things.
at everything.
Yeah,
Look
yeah.
at everything. I mean, and you'd be surprised how basic some of this stuff is. And I don't even know if it's tax planning. It's just planning in general.
Yes.
So it's anything from making sure your beneficiaries are updated. I mean, I brought on a client back in February, and I got a copy of the life insurance policy, and I'm like,
Imagine that.
who's this person? I need to update that. And I'm like, well, you need to go ahead and update that. Because what if something happens to you? This person you don't want to have any money is now doing
It's
it.
a real danger because
That's
that's
a
a
real danger.
contract. And
Right.
they don't care what your intention was. If it's in the contract, that's what it says.
It's going to that person. So fix it.
Yeah.
So,
So that
you know,
lady
of
you were
course-
married to, you don't
That's
want
right. Adjust.
Yeah, you need to adjust that.
Estate planning, so many times I see people who have adult children, like they just turned 18 and they don't have the necessary ancillary documents. Maybe they don't need a will, but I mean, you need a medical power of attorney if your kid's at college and they're in an accident and they're incapacitated.
Oh, wow, that's a really good point.
So make sure you're kind of making sure that if you've got kids that are minors, make sure you got the guardian paperwork and revisit it, because I can't remember who I was talking to who was helping with that, and they said that the number one reason that people end up changing the guardians was because people end up doing drugs
Whoa.
that they thought that they could trust, and then they're like, oh, are they like marijuana or something? So anyway, check that stuff.
Whoa.
I know that's not really tax planning, but it's just planning. And
It's
all this,
planning,
it
and-
starts to morph together though, because you need to be looking at all these things in the biggest picture.
Well, and the point of that is, long before I was in the business, it used to be like a life insurance agent that would have that role and
Yeah.
like would be the planner. They'd sell them some insurance. They bring in some stockbroker. They bring in
Yeah.
an accountant. And I think that's the unique position that your firm is positioning themselves as, is that sort of actual planner that's going to look into this stuff. Now, don't get me wrong, there's some advisors there that are doing
a good job. There are. There's just not enough of them.
I don't think so, yeah.
There's not enough of them, and they need help. And like you mentioned before at the top of the podcast, was like the CPA often sits in this very trusted advisor. So what happens is, this is usually the conversation. Let's just say advisor says, I think you should do a 401k plan.
Yeah.
So what does the client do?
They
They go to the accountant. They say, should I do a 401k plan? Because the advisor just said I should do a 401k plan. And the accountant actually has to agree or disagree, right? Yeah, that sounds like a great idea. Okay. So there's been plenty of instances where a CPA doesn't understand something or doesn't respond. So the advisor sort of becomes on an island because
Yeah.
they don't have anybody to
Totally.
back them up.
Oh, totally,
Or to just
yeah.
collaborate or flesh something out before they bring it to the client. I mean, clients are easily confused. They're like, I don't understand profit sharing contribution versus a match versus a deferral. Like, just how much money? How much money do I need?
And that's a good point, because the client could miscommunicate it to the CPA. The CPA could not understand. The accountant could not understand and kill the deal because they don't understand. They could kill the deal. They could kill the idea because they didn't bring it up even, that's a dumb idea.
Right. Or they have some arrangement with somebody else where they end
Yeah.
up getting some type of referral fee or whatever, which is, these are all the things
That you gotta think about.
You got to be thinking about, yeah. So I really encourage people to, work with people who are willing to be professional and coordinate. When people don't respond, financial advisors don't respond, or attorneys don't respond, or whatever, it just puts a damper on just getting everything done.
Yeah.
So
Yeah, that's a
work
good
with
example.
real professionals. So.
And I can give a couple of examples. Like, I'm working on a buy-sell for a client of ours, and, rather than telling them to go to their attorney, I said, you know what? I know your attorney. I'm going to call your attorney, and I'm going to tell them what we're doing. And they're like, that'd be great. It's like, that'll take me 5 minutes to explain to the attorney what we're trying to do.
Yeah.
Versus hoping that the client says, look, we're going to do a cross purchase here, and here's the values.
Oh
that we're
yeah.
using.
Okay. So this is interesting. So I feel like I'm going to use my husband as an example. We had this thing come up, and he was I had explained it to him, and then he was explaining it to somebody else. And
Oh,
I was
gosh.
like, you need to stop talking. That's the wrong information. But it's kind of typical of what I think most clients hear one thing, and then they're saying something altogether different.
Totally.
Because they don't really understand it. And so I think we help them so much when we just save them from, not because they can't understand it, but because really they shouldn't be troubled with having to understand all of the intricacies of something. We want them to understand the big picture, but not like this box needs to be checked and this and that. Like, that's really something professionals should be more actively working together on, and then coming back to the client and saying, look, here is the big picture. Do you agree with these big moves we're making?
I agree. And I hate personally someone like, this is how this, maybe I want to know, but just tell me the overall effect and why I might want to do it that way, and then what you would do.
Yes.
Like, I think advisors make a lot of mistakes in, well, you could do this or you could do that. What do you think?
Yeah.
Well, I don't freaking know what you said half of the time.
People just want to be told what to do.
Yes.
I kind of refer to this as kind of being their mom.
Yes.
Like, you're going to be your mom. And if I was your mom, this is what I would tell you to do.
Yeah. Yeah, exactly. No, I totally.
Yeah, they
totally
want
agree.
you to level with them. Don't give me 7 options and like you choose. Like you're the expert. You tell me which one I should choose from based on everything you know about me.
Or I'll find somebody to tell me
Right.
that. Yeah.
The problem is they don't. A lot of times, both the advisors and the CPAs don't know everything about the client, so it's hard for them to make the recommendation because they either haven't taken the time, or like I said before, maybe the client has been a little too closed off and not sharing the whole picture. So you've probably seen examples like this of where a client has chosen 2 advisors, or I'm self-directing some of the money,
yeah.
and I've got an advisor doing the other half. Okay, and so you start working on any type of like planning stuff, even on tax planning. It's like, okay, well, the advisor sort of knows what kind of money moves they're going to make. Okay, so a client, now you're self-directing this. What are you going to be doing? Well, I don't know. Okay, well, we're planning here. So are you going to sell all this dividend, producing stock? Are you going to keep it? It's highly appreciated. Like, what have you thought? They don't. So we've got these, we've got bifurcation happening. And we need to bring these things together so that there is a
Totally.
cohesive, ongoing strategy and communication so that, one, we're also the financial planning part that you are working on and life insurance planning stuff, that's easier. And then the tax planning gets easier. But
No.
none of it's possible without that.
That's 110% correct. And how often do you see, I particularly think it's maybe less confident advisors where they'll allow their client to have like 3 other advisors. And it's like, how can you not communicate to that person that this is making it harder and we're going to make mistakes because there's 3 different people. There's 3 cooks in this kitchen and we're all making different things.
I don't know. So I was...
Or is it the personality of the client? Maybe it's the personality of the client and you need to just pass those people up. I don't know.
Maybe. I don't know. I mean, I'm not a financial advisor, but I advise my clients to get one financial advisor. Like I've got a client right now who he self-directs everything. But like when it comes time for he does have a defined benefit plan and a 401k plan. So when we go to fund that, oh my gosh, it is like monumental effort because we can't pick up the phone and call a person and say, hey, can you get this done? We're ready to transfer the money.
Yeah.
It's like call a 1-800 number and no, you have to like log in. They're going to walk you through it and you have to click 700 things and then try to remember next year.
You need to
How
fire
you
that
did
guy. Life's too short, Susan.
Yeah, I'm just too nice.
You are
That's
too
all there is.
nice. You're way too nice, Susan. All right, one big, beautiful bill.
Oh, man.
Big deal.
Woo! One big, beautiful, big deal.
Yeah, so the
Yes.
estate thing, the SALT thing. I mean, there's a lot of things in it.
There's a lot of things in
But
there.
what's the biggest thing you think that, or whatever you want to talk about with it? What do you think's interesting about it?
Well, I think for the business owner clients, there's not going to be that much that's going to change for them.
Yeah.
I mean, I was doing some modeling, looking at, for one client, because we're in the middle of tax planning for all of our clients right now, in mid-year tax planning.
Right.
And I was sort of modeling, like, let's compare it to, just if 2024 gets repeated, what would it look like under the new bill versus, and then in 2026, the new. Okay, so a few things that I think. If you are charitable minded, there's going to be the 0.5% floor starting in 2026. So
Yeah, I heard about that. That was kind of a weird.
it's kind of strange, yeah. And I mean, it's just.
Who came up with that? That's just.
I think it's got to be a revenue raiser. Is really, they,
Yeah. So explain it a little bit further.
Okay, so basically, you have a 0.5% floor, meaning that whatever your AGI is, you might multiply it times, 0.5%,
Yeah.
and that particular amount is not going to be subject to deduction. So let's just say the math worked out where it's like you made $10,000 worth of charitable contributions and the floor was $500, then you would only receive a benefit of $9,500 of the charitable deduction.
And I just don't get it.
I don't either. But if you were going to make a charitable deduction or contribution in 2026, maybe you would accelerate it to 2025 and get the better benefit.
Good point.
So, I mean, it might not be huge dollars, but
If you're thinking about doing like a CRAD or a CRUD or
Yep.
CRT, whatever,
Yeah.
you might want to do that now.
this year would be the year to do it because you're going to lose a potential, especially as those dollars go up, right? I mean, that floor, that 0.5% is going to be more significant the more
Yeah, you
your
make $1
AGI
million,
is high.
0.5% is 5,000.
Yeah, I think so.
Yeah,
Yeah,
5,000.
5,000, yeah. So, I mean, that
Who's
means
got a calculator?
it's not chump change, but
It's not nothing, but
it's not nothing. I mean, you make $1 million, maybe you're not too worried about it, but I don't know if it's going to deter those people, but it is just eroding the benefit.
it's just a
So-
weird thing to tack on.
Yeah, I think that the reduced benefit on the sliding scale on the salt limitation. So the floor is still 10K. You still get that no matter what. But pretty much when you start making married marginally over 600K, it's gone. That 40K, is 40K max. But by the time you get to 600K, it's just gone.
Oh, so for most people, it's not. Most people that are going to hit 40,000 of salt, which is state and local taxes,
Yeah.
which
Sales
would
tax,
include
property taxes.
Yeah, I was
it's
about to
property
say.
tax. For people here in Texas, I mean, if you live down in, Highland Park,
It
they're easy paying 40K, but they're probably all making over 600K, so they're not going to benefit from it.
Yeah, I mean, if you're able to afford a house
So-
that has $40,000 worth of property tax,
taxes.
you should probably be doing okay.
Yeah, you should probably be doing okay. So unless you've deferred it all into the future, and I don't know if that's smart.
Yeah, that's a good point.
Yeah, so I think what we'd probably say on the OB3, it's huge changes for the business owners themselves and high earning individuals. No. But I think what they need to do is they need to be aware of the impacts that this bill is going to have on their employees.
Okay.
That is probably what I would begin thinking about. And I would also
So what do you
say-
mean by that?
So the overtime deduction, if you're paying hourly employees and now they receive they're eligible to receive the overtime deduction of 25K, which is only so if you make $10 an hour and your overtime rate's $15 an hour, you're only receiving that deduction on the $5, not on the full 15,
So meaning,
up to 25K.
so on the overtime amount, if I work overtime I'm an hourly wage earner and I work overtime, all of my overtime pay up to 25,000 is deducted from my income.
That's right, yeah. And it's a below the line deduction. So it's not a deduction for AGI, it's after AGI.
Interesting.
Yeah, but it's only on the incremental overtime hour rate.
Yeah, so to hit 25,000,
I mean, you
probably
have
gonna
to
be
you
making quite a bit.
You do, and you have to be hitting a lot of.
overtime.
That's right. So, but important.
But that's going to be,
It's going to be important for you to communicate to your employees, and then probably also to your payroll people, because we're going to have to also figure out how that gets reported on W-2s.
Oh, good luck with that.
So, again, not necessarily stuff that's going to affect the business owner, but same for the tips thing. It's the same, works the same way.
And it's
And there's
similar-
phase outs for all of these things. I mean, it's not as just cut and dry as you think it is. So there's that. Also, I think for employees who are purchasing vehicles, that the 10K in interest, auto loan interest, another below
if
the
you're
line, below
buying-
the line deduction.
if you're buying a vehicle for
Personal use, yes.
that you
and-
use for a business,
No, it has to be some personal use.
some personal
Yeah,
use.
that's the way that it says, some personal use. It has to be assembled in the United States, blah, blah, blah. I mean, there's a bunch of rules again, but
Oh, that's complicated.
yeah.
So maybe discount that one.
yeah, but your employees might need to know about this. So I think employers might actually have a real opportunity to educate their employees about how this could help them.
That's
I
a
think
good point.
I think that's what I would do if I had a bunch of employees who I'm paying hourly rate or tips or overtime, or who I know, need these deductions, as I talk to them about it. Now, the interesting thing, maybe the most interesting thing to me, is the Trump accounts, because you can't open one until July 4th, 2026.
Okay.
Okay, and it
July 4th next year.
next year.
So
But-
a little over 365 days, or a little less than 365 days from
Right,
now.
5K a year per kid until and there's something weird about the age, like I think it's like 17, but they have access to it when they're 18. Okay, up to 50% for home, for buying a first time home, college, whatever, and then the rest they think is going to be basically an IRA. Okay, not Roth IRA, but IRA. Questions loan can be converted to a Roth IRA. Don't know. Okay, but there's a provision that says employers can contribute up to $2,500
Wow.
for Trump accounts. Now, of course, there's all the can't be highly compensated employees and all that. I mean, there's no discrimination. It's going to be no discrimination.
This is the first time I'm hearing about this.
Okay,
so
yeah.
you mentioned it before we started, and I was like, I don't know what the hell she's talking about.
I mean, you just think about if you.
So wait a minute.
If
So
you've got people who, most business owners are older, so their
Right.
kids are probably, older, 17, 11, 12, 13. I mean, maybe
Yeah.
you get a little bit older, but your employees who you're employing usually have young kids.
Well, I have a
So-
6-year-old, a 4-year-old, and a 2-year-old.
Okay, so yes,
each
exactly.
one of those kids, you can put in $5,000 to the Trump account, and that's a deduction.
And $2,500 is an employer can do it for its employee.
So we could do it from the business.
That's right.
Well,
So
I might. Well, anyways.
so potentially you could get a $7,500K deduction in your business. Okay.
Wow.
Now, presuming that doesn't meet all the other rules, it's not, it just meets the rules for not highly compensated and some discrimination. But think about what you could do as a benefit to your employees. What another retention getter
Yeah,
or
that's
attraction.
really
We offer
interesting.
this. I mean, maybe you don't have to do the full $2,500, but what if you do $1,000 if you've got little kids?
Wow.
You don't have to put that money in my pocket, but if you're putting that money in my kids' pocket and helping me build wealth for my kids, wow.
And then
Tremendous.
it's like
And you
tax
get-
deferred growth.
Right,
and
yeah, it basically
whatever.
functions like an IRA at
Yeah,
that
yeah,
point.
yeah. Wow. And then any contribution that you make as an individual is deductible?
I
Don't know.
don't know.
Don't
I
know
don't
yet.
think so. I have not heard that. I doubt it.
Wow. Yeah, I doubt it too.
I doubt it.
That'd be probably too good.
Yeah.
Wow, this is the first I've heard of this.
Yeah. So
It didn't get much pressed, I guess.
Well, I think that's because it's not active yet. So,
Yeah,
but
good
I think
point.
the other thing about the OB3 is some of it's effective in 25, some of it's effective in 26. There's all these different weird dates that are.
Well, it
they
was
got some
like-
crazy stuff in there. I mean, for start dates and end dates, and so just talk to somebody. I would say if you're paying a lot of state and local taxes, if you make overtime, if you make tips, that's probably not going to be business owners. QBI is pretty much the same. If you are going to buy a lot of equipment, but one of the things, this is brand new, something called qualified production property. Okay, so there's a lot of
Qualified?
rules, and I don't know all the rules because I'm probably not going to have any clients that this applies to, but basically, this is kind of the gist. If you are purchasing a building, it's
Yeah.
new to you, it's never been used by you for manufacturing, okay? And it
Okay.
has, manufacturing in this case has to be like substantial transformation of a good. Okay, so like taking melted plastic and turning it into like a doll.
Yeah,
Okay,
yeah,
would be
yeah.
substantial transformation.
Assembling a car.
Some potentially.
Maybe.
I don't know.
Yeah.
I mean, like question mark on what Congress meant by that. But the entire purchase of a building. So let's just say you bought a piece of property, $10 million, $3 million on land, $7 million when you allocated the land building cost,
Right.
$7 million in building. It meets all the other requirements of qualified production property. Year number one, you get a $7 million deduction.
Wow.
The entire building, what would have been 39-year property, written off year one. Okay. If
Wow.
it ever moves out of manufacturing or that production process, you have to recognize 100% of the depreciation recapture in that year. Okay. And you have to do it for a minimum of 10 years to benefit from that. And after that is Section 1245 property, the building, and you could swap it under a 1031 exchange. Wow. Swap it to a drop and know that your heirs would essentially get the step up in basis and no one would ever
So
have to
if-
recapture that depreciation.
If you are any sort of business that,
Manufacturing,
yeah, build something.
yes. It really makes me want to go be a manufacturer. But then I'm
You
like,
wanna
I don't want to spend money just to save taxes.
Yeah,
Oh,
yeah.
that
We
doesn't sound good.
didn't we already talk about that being dumb? Wow.
Yeah, so I think for anybody who's in manufacturing, I mean, it's what they wanted to encourage, right?
Do you want to start a manufacturing business?
Yeah, that's what I'm saying. Yeah, let's start one. Okay, Jordan, let's do it. I say let's do it. So I would just say be on the lookout for all these interesting things as they
I
pop
wonder
up.
if they'll start. Well, like how some of these property investors, they'll put a bunch of people together to get the depreciation, to get like deductions. I wonder if people start doing that with manufacturing.
I have to imagine that private equity is probably going to be all over. I mean, they usually lose money anyway, but I mean,
just to get some.
it's going to. It offsets future income if you.
And if you're
can't pay
buying a
out the
piece of
loss.
property, you put up $1 million on $10 million, you get $7 million deduction. It could be.
If you make money as a manufacturer, it is going to be heaven.
Oh yeah, seriously, that's really interesting. And then the only other thing that was big news, at least in the insurance business, was the estate exemption.
Yes, yeah.
Which
yeah.
is quote unquote permanent, but I don't really know what that means.
So I was listening to some accountants talk about this. They what do they call it? A temporary permanent?
Temporary permanent, yeah. Temporary. It's permanent. I was saying it was permanent till it's not.
That's
So
exactly.
whatever that
That's
means.
exactly right. It's permanent until it's not. Until 2028,
Yeah,
maybe.
yeah,
I don't
right.
know. Oh my gosh. We'll see.
Yeah, we'll see. So, Susan, thank you. Thanks for your
thank you,
insights.
Jordan. This was so much fun. I love talking to you.
Thanks for coming out. I love talking to you too. I don't know if you have anything else to add. If you want to talk a little bit about Unbox, what makes you guys unique, because I think you're running a very unique. I guess you could call it CPA, but that's not really a CPA firm. It's just you happen to be a CPA.
Yeah, so Unbox Advisors, we're kind of unique in that we kind of take a boutique approach to things.
Right.
We don't want to work with hundreds of clients. We really want to help individuals who own businesses to achieve financial freedom.
Yes.
And we know that saving taxes is a big part of that, but also working with an amazing team of advisors like you really helps to make those dreams possible. We just know that it takes so many people, smart people,
Yep.
to make that happen. So we just like to be the chief ringleader of bringing those teams together, surrounding those clients, and helping them accentuate the things they're already doing great.
No, I think you do the best job out of anybody that I've seen do that, and no, I think you do a great job. So,
Wow.
so thanks.
Right back at you.
Yeah, thanks, Susan. Thanks, everyone. Yeah, thanks. Reach out to Susan if you need some tax help, I guess,
Yeah, please.
or planning help more specifically.
Yeah. Thanks,
So,
Jordan.
Thanks.